todavía no hay nadie en el atril, no tiene pinta de que vaya a comenzar próximamente. Me parece que ya tenemos con nosotros al siguiente invitado, a Edward Moya, Chief Market Strategist at Market Pulse and Oanda. Edward, good afternoon. Edward, tomorrow is the big day in the US, the inflation day. What are we expecting for tomorrow for this data? Is there any possibility that a low reading tomorrow may get the Federal Reserve to not hike interest rates?
I think we should be prepared that we could see a rather low annual headline read. We might even test the 2% level, 2.9% on that year-over-year reading. But I think the Fed is going to be fixated with core, and the monthly readings are still going to, show signs that inflation is probably going to be sticky throughout this summer. So I would anticipate that even if we did see a little bit of a cooler report, the Fed is still going to go forward with that July rate hike. I think there's just too much that has been signaled, and they need to remain aggressive with this tightening stance.
Edward, this week we have the first earnings of the season, of the summer season. As always, the banking sector is the first to start off. What are we expecting for this earnings season, for this summer?
Well, I think I will say, throughout the pandemic, the recovery, it has been rather impressive to see how well the banks have performed. And I think going into this earnings season, the bar is set fairly low. I think there's been a lot of pessimism. But I think what we're going to realize is that loan losses are becoming a little bit more of an important theme here. And I think that lending is taking a hit. I think we're going to start to see more signs of expected weakness from the big banks. And this is going to weigh on the outlook, weigh on the consumer. So I would not anticipate a rather strong beats across the board. I think we're going to see a lot more concern with these outlooks. And as their capital requirements are going to get raised, I think you're going to see there's going to be so much tightness that you're really going to see the impact, I think, on lending take place in Q3. And that's probably why I think there's going to be a lot of cautiousness going into this earnings season.
Are we going to see any changes in guidelines precisely because of what you just said about those capital requirements?
I think what we should anticipate is the banks know that we're still waiting to see the overall impact from the stress that the regional banks have had. But I think the key trade is going to be that the banks are going to have a lot more money put aside. Capital requirements are going to go up, and I think you're going to see that this is really going to impact margins. I think we're going to really start to see that become a key focus this earnings season. And I think you're probably going to see that. I think a lot of people are going to anticipate that consumer spending is probably going to be rather weak in the second half of the year. And this is, despite all the strength that we've seen with the labor market.
Mm-hmm. Summer, Edward, tends to be a season that investors try to avoid in the stock market. Should this be the case for this summer? Because last year, August, for example, was a pretty good month in the year.
I think, the last few years, you've pretty much thrown away the playbooks. But I think, going into this summer, you're starting to see that, the market has been fairly quick to push back those Fed rate cut bets. I think there's no reason to anticipate the Fed will cut rates this year. I think that we will probably start to see much weaker data in the third quarter. Maybe you could make the case that December could become a live meeting for a rate cut. But no, I think, stocks have really, I think, overextended themselves. So I think selling now and waiting for a pullback could be a sound strategy right now, just given how the market's positioned and given how we've really seen, I think, some exhaustion with the AI trade.
Moya, Chief Market Strategist at Market Pulse and Oanda. Thank you so much, as always.
Thank you.
Bueno, y por cierto,